Vicky Price joins us, Chief Economic Advisor at the Centre for Economics and Business Research. And Jonathan Davis is on the line, economist and wealth manager. Vicky Price, what do you think?
As we heard, it was widely expected, but I think it's the wrong move. The economy is showing all the signs of slowdown coming. And, of course, the Brexit uncertainty we've just been talking about is adding hugely to businesses' unwillingness to invest. And the consumer has been suffering from a decline in real disposable incomes now for a number of quarters. We've seen already that retail sales are being affected by this. The consumer is now focusing more on buying essentials rather than luxury items or things it doesn't need, such as cars, for example, or replacing their cars. And even in manufacturing, which is doing better than would have been the case otherwise, given the fall in the pound that we have seen since the referendum. There we've seen car production, for example, being really quite low, and the overall balance of payments and the sort of deficit that we had traditionally has expanded rather than declined.
So you think it's a bad move because it's going to hurt people. Jonathan Davis, you think it's a good move?
Short term or small picture, I think actually it's a reversal of the mistake a year ago when they cut the interest rate. There was no reason to do so. And big picture, the government and central bank policies of bailing out the banks nearly 10 years ago, zero interest rates practically, money printing and so on, it has created the most inequality in wealth and income that we've ever seen, and B, it's created the lackluster economic growth that everyone's talking about. So if this is the start, potentially over the next few years, of a reversal of those policies, power to it, bring it on.
Vicky.
Well, funnily enough, if you look at the data, inequality has been reduced since the financial crisis. And, of course, it has been reduced. If you look at the figures that have been coming out of the Office for National Statistics and others who've been measuring it, including the Institute for Fiscal Studies. Because, remember, there are loads and loads of young people and who are buying homes who have benefited from very low mortgages, loads of people benefiting from low interest rates, the ones that are barely managing. They actually found all that to be a huge benefit. And without the quantitative easing, the extra liquidity in the system, and the cut in interest rates we've seen, we wouldn't have been growing.
These loads of young people who are buying homes, I haven't met any.
There are loads. If you look at the new buyers, yes. I'm not suggesting that home ownership is anything like what it used to be before, but for anyone who has had a mortgage, and quite a lot of young people have had mortgages as well, and also the middle, those who, as we said, are on median incomes, they have all benefited very significantly from low fixed mortgages, which wouldn't have been the case otherwise, very cheap loans to buy cars or anything else that they needed. So, but if we look at the overall measures that the Bank of England has put in place since the referendum, they have eased the concerns about a financial crisis that we all thought was going to happen and allowed the consumer to go out and spend. Without that, we wouldn't have had the growth that we've had.
Well, that's the key thing, Jonathan. They've released money into the system when we had a massive crisis, and maybe today is the moment we say we finally put the crash behind us.
The god of those people's economics, John Maynard Keynes, defined the Depression as an extended period of slow or no growth. With the biggest economic stimuli in human economic history, all we're getting is about 1 or 2% per annum growth. We're getting the rich getting richer, we're getting the middle class poorer, and we're getting the poor going absolutely nowhere. The idea that inequality is falling is such balderdash, it's unbelievable.
You just have to look at the statistics, I'm afraid.
Rising inflation because the central banks have kept interest rates too low for too long. Thus, oil and other base metals like copper and energy, they've been soaring on world markets. For example, in the last year and a half, the price of oil has gone from $26 a barrel to $54 a barrel.
Vicky wants to come in.
As far as I can tell, it's going to the 70s by next year.
Right.
I mean, we have higher and higher inflation because of low interest rates. The people who have to pay for this are the middle class and the poor. The rich don't really care much oil is, but we do.
Okay.
And we're the one paying
Go on,
for it.
Vicky.
Okay. Well, Well, the world economy has enjoyed a very long period of very low inflation, partly because of globalization, partly because until recently oil prices were coming down through the period of very low interest rates. So that argument doesn't hold at all. In addition, the inflation rate we have here in the UK has got nothing to do with the 0.25% interest rate we've got. It has all to do with the fall in the pound, which has increased prices of imported goods. We are an open importing economy. We created it by voting to leave the EU.
Oh, he thinks the pound fell because we had low interest rates.
Nothing to do with that. It fell
Really?
because, imagine, reducing the interest rates by a quarter of a point makes very little difference. What actually made the difference on the exchange rate is the realization of the markets that the UK was moving into a slow growth environment and therefore was going to be suffering in terms of what it would be doing on its balance of payments side. So they sold the pound.
Jonathan, I started with Vicky. Let me finish with you. What if you could do? If you were in charge today, Jonathan? We've had the Defence Secretary resign. Maybe there will be a vacancy for Chancellor later. If you were in charge today, what's the single thing you'd do?
The single thing I would do is I would announce to the world that we will no longer bail out failed businesses. And that has so many repercussions to rebalance the economy to benefit the poor and the middle class.
Thank you very much, Jonathan Davis, economist, wealth manager. Vicky Price, chief economic advisor at the Centre for Economics and Business Research, talking about the rise today in interest rates.